Today I would like to analyze Hermès. It's one of the biggest luxury brands in the world, and I think they're very popular with women, especially they selling these bags, and I think many women like to have one of this. So about the stock, we had a decline in this month, close to 5%, and in 6 months it's 8%. But they are still up over 5 years. They are up 170%. So they could be still overvalued if we look at just the chart, but we have to take a look at the financials to know more if this is a good buy or not. The first thing we can notice is a big market cap of 210 billion euro. So this is when we take the shares outstanding, multiply with the stock price. And this is a big company already, so this could mean they will have difficulties to grow in the future, but we will see. Now I would like to take a look at the financial foundation. The first thing I'm looking for is revenue growth over the 5 years, because we want to invest in a growing business. So we can see here, in fact, they had a revenue growth every year except of the COVID year 2020. So this is looking good. They nearly doubled the revenue in just 5 years. This is great. So it's a check here. Now we are looking for free cash flow growth over the 5 years, because this is how the company pays a dividend or buy back shares. So it's very important for us. So we can see in 2019 we had the 1.74 billion, and then it did decline in COVID 2020, and now it's already increased again, and now a small decline, but we are still up over the 5 years and in a good amount too. So we have the check here. Now we're looking for the free cash flow yield over 4%. This can also show us the valuation of the company. So we're gonna take the free cash flow here, 3.7, and we're gonna divide it with the market cap of 210. So then we get the number 0.0176. This means 1.76% free cash flow yield. So this looks very low actually, especially as this is already a very big company and the free cash flow yield is not very high. So it's not a check here. Now we're going to look at the balance sheet. We want the debt to free cash flow ratio under 5. This means we can pay back the debt with our free cash flow in under 5 years. So we're going to take a look at the debt here. We can see here short-term debt 290 million. And then we're also going to look for the long-term debt. Here, you can see here 1.7. And then we're going to divide it with the free cash flow that we already had. So we will get the number. Wow, so this is 0.5567. So actually in under 1 year we can pay back the debt with our free cash flow. So they are very stable in the balance sheet. We can also take a look in the cash on hand. So we can see here they have a lot of cash on hand, over 10 billion. This is great. So they can pay dividend with this or buy back shares or invest in their business. So we have to say they have a really, really good balance sheet, and this is a check here. The last thing would be shares outstanding decrease, especially when we have the big company already. We would like to see them buy back shares. But in this case, I actually don't like to see them buy back shares because I think they have a very high valuation. So if they buy back shares right now, it means they pay a high price for the shares. But actually we can see they didn't buy back many shares. In their last year they did a little bit, but over the 3 years they increased the shares outstanding. So I would say it's not a check here, but this is not bad too, because the stock price is very expensive. So if they buy back shares, they would buy it for the very high price. So my conclusion for this company is they have an iconic brand. They are very popular. They have the good financials as well, so they have growing revenue, growing free cash flow, and they have a good balance sheet. They have a lot of cash on hand and not much debt. But to me, this company is overvalued because they have a very low free cash flow yield. So this can indicate the overvaluation. And also the stock price is very high. For the last 5 years, it's up 170%. And it could go more down. And I also think they will have difficulties at this big size to grow. They are a very, very big company. And they are still in the hype business, so they can be popular now, but in the future it's not sure. Maybe they will become less popular, and they only rely on one brand. This is also a bit difficult. So I hope you liked the video, and please don't forget to subscribe and like the video.